Hi guys, are you guys faced with the dilemma of selling your home and cottage? I know I'm not, but I can show you guys how to calculate the taxes for it. So in this video, I want to cover 4 cases. First is what is principal residence and what is principal residence exemption. Second is why should you care? And then third is when can you apply principal residence exemption? And then fourth is how to calculate principal residence exemption and how to apply it. So what is a principal residence? A principal residence includes any housing unit used for non-income producing purposes, such as a house, a condo, a cottage, or a mobile home. It's ordinarily inhabited at some time during the year by the taxpayer or the taxpayer's spouse, common law partner, former spouse or former common law partner, or the child. So only one residence may be designated as a principal residence for a family unit for a given year. To qualify as principal residence, 3 points. First, a property with non-income producing purposes used for living and residence. Second, it's ordinarily inhabited by the taxpayer or the taxpayer's spouse in that year. And then third, a family may only designate one home as principal residence in any given year. There are situations where principal residence exemption will be avoided. 2 items that will eliminate the principal residence exemption privilege is when you rent out the property and when you claim CCA on that property. By renting out the property, that equals to rental property. It is therefore no longer a principal residence. By renting out the property, it is now classified as income producing purposes. Principal residence exemption relates to non-income producing purposes used for living and residence only. The second conflict is when you claim or deduct CCA on home office. This is not recommended as it could result in issues with the tax exempt status of that home as a principal residence. Principal residence is considered non-income producing for residence purposes. So once office CCA is claimed, it converts that property to income producing property, therefore removing that residence status. What is principal residence exemption and why should you care? Principal residence exemption is for personal tax returns. If you sell your properties for more than what you bought it for, meaning that your sale proceeds are greater than the cost of the properties, you can reduce the capital gains through principal residence exemption. Principal residence exemption allows the Canadian taxpayer to be exempt from paying all or a substantial portion of the capital gains that arise from the disposal of properties considered as principal residence. When do we apply principal residence exemption? There's 2 situations which you may choose to apply principal residence exemption. The 2 are first the voluntary sale of your property, and then second is the deemed disposition. So for voluntary sale of your home, this is, for example, when you downsize your property or house upon retirement age to, let's say, a smaller home. You can claim principal residence exemption as long as there was no CCA or business expenses that was claimed on that property. The property was used only for residence purposes. In deemed disposition, to me, this means like a forced recognition of capital gains or capital losses. It's like a forced recognition of adjusted cost base against the fair market value. So deemed disposition means there's no actual sale that occurred, but a capital gain or a capital loss is incurred. The property is treated as if it was sold at fair market value, and a capital gain is realized at that point in time. I'll give you guys some examples and situations that would trigger a deemed disposition. Situations include a death of a taxpayer, divorce, a resident becoming a non-resident, so cease of citizenship, and then sole proprietorship converting to a corporation, and when a business use property is converted to a personal use property. So in the 4th phase, how to calculate and apply principal residence exemption. So in today's example, let's say the current year is 2018. For any examples, let's say the current year they give, you want to use the end of that year. So therefore, if it's 2018 in your calculation, you'll use 2019. The home is acquired in 2000 for $300K. The cottage is acquired in 2004 for $150K. The fair market value of the home right now is $500K, and the fair market value of the cottage is $250K. So for any principal residence exemption calculation, I apply these 5 steps. So the first step is calculating your gains per property. Second is the gains per property per year. And then third is to nil the property with the highest capital gain per property per year. And then the fourth is use your remaining years to reduce the capital gains of the second property. And then the fifth is to apply 50% to the capital gains to get your taxable capital gains. So let's perform the first 2 steps. First is calculating the capital gains per property, where you're going to take your fair market value minus your cost to get your capital gain. So for the home that was acquired in 2000, the fair market value is 500K minus 300K gives us 200K. For the cottage that was acquired in 2004, we're going to take the fair market value of 250K subtracted with the cost of 150K to give us 100K. And then in our second step, we're going to calculate the capital gains per property per year. So what you're going to do is you're going to take your current year, subtract it with the year acquired to get your year's own. Note that in the current year, let's say it's 2018, you always want to use the N of. So therefore, if it's 2018 now, we're going to use 2019. We're always going to assume the end of that year. So for the home, we're going to take the current year of 2019, subtract it with the year that it was acquired of 2000 to give us 19 years. For the cottage, we're going to take 2019 and subtract it with the year that the cottage was acquired of 2004 to give us 15 years. The next step is we're going to take our capital gain and then we're going to divide it by the years owned to calculate our capital gain per property per year. So for home, we had a capital gain of 200K. We're going to divide it by 19 years of it being owned to give us 10,526. For the cottage, we're going to take the capital gain of 100K divided by 15 years that it was owned to give us 6,667K. So in this scenario, the home had the highest capital gain per property per year. Therefore, we're going to nil the capital gain for the home first. We're going to carry the 10,526 into our third step. In the second step, you can also determine the maximum amount of years to claim. In this case, the home was owned for the longest, for 19 years till the present date. So 19 is the maximum amount of years that we can use to claim. So let's perform the next 3 steps. In the third step, we're going to nil the property with the highest capital gain per year, which we determined in step 2 to be the home. The formula to calculate the exemption will be capital gain of our home multiplied with the 1 plus years owned less 1 of that property over years owned of that property. So we're going to take the capital gain of the home of 200K. We're going to multiply it with 1 plus 18 divided by the years owned, which is 19. This is just basically 200K multiplied with 1 equals to 200K worth of exemption. So in this step, we basically eliminate the entire capital gain of the home. Okay, in the fourth step, we're going to use our remaining years to reduce the capital gain of the second property, which is our cottage. So the formula will be capital gain of the second property multiplied with 1 plus the years that are remaining available for us to apply over years owned of that second property. So we're going to take 100K in capital gains from the cottage. We're going to multiply it with 1 plus 1 over 15 to give us 13,333 in reduction of capital gain. We had maximum years to claim of 19. We used 18 here, so therefore we only have 1 year remaining to allocate to our second property. So therefore, that 1 year remaining is right here. So in our fifth step, all we're going to do is we're going to summarize and we're going to apply 50% to get to our taxable capital gains. So our home had a capital gain of 200K, but we applied our capital gains exemption of 200K to reach 0 capital gains for the home. So what we have left is the cottage. The cottage capital gain is 100K. We have the remaining reduction of 13,333. Therefore, our remaining capital gain for the cottage is $86,667. We're going to apply 50% to that to get our taxable capital gain of $43,334. We're going to add this amount onto our personal tax return to get to our net income for tax purposes.